Joining us now is Tom Lee. He's Fundstrat's head of research and a CNBC contributor. It's good to see you joining us from the nation's capital today. So what's your take on everything that we are talking about now daily?
Well, I heard the earlier segment, Scott, and I do think I'm kind of more in the Jamie Dimon camp, you know, that and Steve Leisman's point that there's opacity in private credit, and that's the problem that investors are going to grapple with for some time. And I think that, along with the trade tensions and, you know, the VIX spike, is the reason investors are a little cautious. But I don't think that's going to change that markets still have a lot of tailwinds into year end. And part of it is AI is like, I think demand is accelerating there. And we know that investors are sitting on a lot of cash, and institutional investors are really having a terrible year. Only 22% are beating the benchmark. So I think there's a bit of a chase. And then sentiment has flipped negative, which is always a contrarian buy signal. So, you know, I think despite this mounting wall of worries, including the shutdown, I think it sets us up for a pretty good rally into the end of the year.
It sounds, though, like this is enough on your radar that do you think it's at least changed the game in the near term for the market?
On the private credit?
Just overall, I mean, if there are continued issues in private credit and the leveraged loan market, then the stock market's not going to take that well. I mean, you wouldn't think.
Yeah, I mean, Scott, the only thing that I don't know is how many chapters it's going to take to play out, because, you know, I mean, there's opacity, which is what is scaring people, but then there's real credit deterioration, which I don't think that's what's happening, and I think that's why Adam and all those had called it idiosyncratic. I'm kind of in that camp because high yield spreads have behaved. So I think it's more of is the flow of capital, because I think one of the biggest sort of allocations for alternatives has been private credit. It's going to make investors pause that, you know, maybe this market it's not as easy a return as it looks.
You told me, I think, a couple of weeks ago that 7,000 on the S&P by the end of the year was realistic. Do you still think that we could get another 5%? That's what it looks like. It's 5% between now and then. Do we have that in us?
Scott, I mean, 5% is just an average fourth quarter from 1950 to 2024. But we have the Fed easing after an extended pause. So that's 1998 and 2024. So I think that 5% might be the base case. I bet you it's going to end up being more like 7 or 8% or even possibly 10%. So I think 7,000 is the low end of what we can end the year at.
Wow. And how much do earnings have to do with that?
I mean, earnings are going to matter, but, you know, it's been a good start. I mean, we're barely into earnings season. The banks have been good. 82% of companies are beating. There's a lot more visibility of demand and then less concerns about tariffs because we're kind of working our way through it. So companies have a better sort of visibility over the next 12 months. I think the outlooks are going to be good, and I think that's going to help stocks. And, you know, I think there's a lot of room for multiples to still expand. So I don't think this market's that demanding.
I think it's interesting that you suggest that you'd be a buyer of regional banks and small caps. Why are you willing to do that? That's not putting your toe in the water. That's like putting the bathing suit on and jumping in. Why?
Well, I mean, Scott, you know, I know there's a lot of muscle memory for people from 2023, and that was because of a big change in rates that really caught a lot of banks offside just in their business model. But that doesn't mean that this crisis, which is underwriting being done properly, should have the same issue. So I think that there has been a throw the baby with the bathwater out on the regional banks and the small caps. So yes, I think despite the fact that the Russell had a rough week, I think they're really going to be one of the beneficiaries. I mean, even on earnings basis, small cap earnings are going to grow 48% in the third quarter. That's like 5 times bigger than the S&P. So I think there's still a lot of growth left there.